The British electorate has spoken and the UK has decided to leave the European Union. The Prime Minister is going, the Leader of the Opposition is under the cosh from his own party, and the fate of the Chancellor of the Exchequer is uncertain. Meanwhile, there's no clarity on when the UK will invoke Article 50 of the Treaty of Lisbon, an act which would leave it 2 years to negotiate its withdrawal before its membership of the economic bloc ends come what may. Those are the cards, however, that advisors and clients have been dealt. The question is, what, if anything, should they do now? Hello, I'm Russ Mould, AJ Bell's Investment Director, and the 4 issues I would suggest that need to be considered in the context of a balanced portfolio are as follows. First, will there be a UK recession? None of us can say, but if you think so, and you believe the pound will remain weak for some time, then owning some overseas assets via well-run active or passive funds is a potential hedge to consider. Value-oriented funds will hope to demonstrate that they can offer downside protection as they specialise in buying stocks which are already trading at depressed valuations. For the moment though, the market does seem to be preferring quality, safe and low volatility names. Second, what to do for equity income? With regards to the UK, it's unlikely that advisors and clients will change their strategy, as this is a long-term plan and the dependable yield generators have actually held up pretty well. Risk-tolerant portfolio builders could even look to European equity income funds, as there's a huge deep pool of European dividend payers, or to Asia and Japan, where more companies are focusing on shareholder returns much more intently. Remember that emerging markets have underperformed developed ones for 3 or 4 years now, and the West now seems to bring just as much political risk as them at the moment, which is most unusual. Third, what about other forms of income, such as government bond yields, as they grind ever lower? Some may view government paper in particular as return-free risk right now, but interest rates are unlikely to rise in a hurry anywhere in the West, and inflation seems subdued for now. Corporate bond spreads have widened relative to government, so corporate bond funds could be looking for value in this area, especially at the long end with rates again unlikely to rise. A good flexible or strategic bond fund will also be looking to pick out the value, protect capital as well as grow it, and pick up yield across government, corporate and high yield paper across all maturities and geographies. Finally, what about gold? Gold and silver are soaring and taking miners along for the ride. Some advisors and clients will never touch these so-called barbarous relics, others will warm to them. There are plenty of actively managed and passive funds which offer access to miners or the actual metals, which have haven but also inflation-proofing appeal. Inflation isn't an issue at the minute, but the referendum vote reflected discontent with the dominant economic narrative austerity across the EU, so a new British PM and government may just change that tune as the political debate begins to swing that way in Canada, Italy and Japan to name but 3. If fiscal stimulus joins monetary stimulus, maybe bonds do finally hit the buffers, with the exception of index linkers, and the precious metals could also continue to thrive. This may be the political impact which needs closest scrutiny, and we'll continue to do our best to keep you informed via our regular written and video updates. So thank you for watching, and I look forward to seeing you next time.